Welcome to the Money Show, your ultimate guide to navigating the world of personal finance. So whether you are looking to grow your wealth, secure your future, or just make smarter money moves, we've got you covered. From market insights to expert tips and everything in between, this is where we decode the secrets of financial success. I'm Kavita Thaplial, and let's get started. And before we begin, just in case, because we do your life financial planning on the show as well, we answer your portfolio queries on the show. So you want to send across your questions, you can WhatsApp us your queries on 865-797-4571, and we also have an email ID which is themoneyShow@etnow.tv where you can send across your questions. Alright, so let's begin the show, and the markets have experienced significant volatility lately. Now, despite this, now SIP numbers remain quite encouraging, or one can say less disappointing than expected. In March, SIP contributions declined to almost 25,926 crores, representing a 14% drop in equity inflows. I'm talking about the AMFI number, which we will be flashing on the screen as well. The equity inflow has gone down to almost 14%. However, small cap funds demonstrated resilience, seeing a 10% increase compared to February. On the other hand, 5.1 million SIP accounts were discontinued, a noteworthy development. Now, in last 6 months, major indices have taken a hit. Nifty down by almost 10%, mid-cap 150 index by 16.5%, small-cap 250 index has suffered a staggering drop of almost 20.9%. Now, this creates challenges for SIP investors striving to remain steadfast in the market. The question arises, does stopping your SIP makes sense now? Could it lead to losses? Or perhaps, is this the time to step up your SIP investments? Now, let's dive deeper and decode these uncertainties. Joining me today on the show is Shweta, Head of Mutual Fund Anudati Wealth. Shweta, looking at the numbers on the face of it, at least the AMFI numbers in terms of SIP investors, they don't look worrisome so far, okay? Because we were expecting a much deeper drop in SIP investments per month, but then we are still holding on to 25,900 crores very strongly, which shows a resilience in the market. But then, having said that, we are also seeing dip in equity flows, and we are also looking at SIP discontinuation of almost 51 lakh accounts. Does this bother you?
Good evening, Kavita. So yes, the positive is that we've seen, more of your retail investors being fairly resilient. They're showing actually a very matured behavior, understanding that the benefit of SIP is seen in such markets where we say, the rupee cost averaging plays out, and therefore when markets are volatile is when they should continue or step up their SIPs. That I think I'm seeing a lot of investors following, which is where the SIP numbers at 25,900 continue to be there. On the other hand, you also have another number, which is discontinuation of SIPs. Now, I'll break up that discontinuation into four possible reasons of why this could have happened. One is, your SIP tenors come to an end, so there's been some stoppage of SIPs, and which is very likely in the month of March. People generally start their plans and SIPs in April, continue it for 12 months, and then they restart their SIPs. So that could be one possible reason. People would have achieved their goals, so they are discontinuing their SIPs. It could also be a rebalance where you're shifting from one scheme where you were doing an SIP, you're now shifting that lump sum to another scheme. Fourth, it could be cases where you are worried about markets and therefore you are stopping your SIPs, halting your SIPs for some time. The good part over here also is that if I see the discontinued SIPs in Feb was 61 lakh folios, now it is 51. So it's compared to the Jan number, little lower number from that standpoint. So these are the four possible reasons. I'm hoping most of it could be the first three that I said, and less of the last case where an investor is worried and therefore stopping the SIP.
So when we talk about discontinuing, Shweta, when we talk about discontinuing the SIP accounts, this doesn't necessarily mean that the person will not come back to the market again or has to stop investing. What I also want to understand, the SIP numbers means fresh money into the market in the same portfolio. In the same folios, we're talking about new folio addition also. And if there is a number to folio addition, would you be having that?
So what I was seeing on AMFI is the new folio addition, the new SIP folios created is also somewhere around 41 lakh folios that have been added through the SIP route, and 51 lakh on the discontinuation side. So this in Jan, if I see the number of discontinued folios stood at 61 lakh crore, and the new folios added in the month of Jan or Feb were upwards of 50 lakh folios. So to that extent, newer folios added are less, but the SIP amount remains same. So I'm assuming people have done step up to their SIPs in this market. That's, I think, one interesting data point.
Sure. Let's also talk about the category preferences that we saw in the AMFI numbers also. FlexiCap, as we all know, has again shown a very strong inflow number. Small caps have risen 10% as compared to Feb. Now, what is this new kind of a trend? Are we talking about new money or new SIPs in small cap, fresh money coming in small cap funds?
Yes, so flexi cap, given the market situation, also when it is volatile, the easiest is to get into a flexi cap category and leave it to the fund manager to decide which market cap he wants to allocate, where the fund manager deems fit. Also, most of the flexi cap funds have a large cap bias. On an average, as a category, if I see, roughly 70% would be getting invested in large caps within a flexi cap category. So it kind of is comforting at this point of time to be in this category, which is where you see flexi cap receiving, the maximum flows. Small cap, I would say, I think, the reason why investors were worried and we in between saw a reduction in the flows coming in was valuations as a concern and profitability a concern over here. Plus, small caps, if you see from the last financial year onwards, had seen a significant run up in their prices. So these were three factors. And now if I break down each of these three factors, we've seen small caps correcting from their peak levels to the extent of 20-21%. That has brought valuation down into a very reasonable zone for a lot of small cap companies there. Plus profitability standpoint, if you see the next 1-2 years projections that are coming in for this range, and I was just seeing various reports on Bloomberg, they're talking about anywhere between 14 to 18% growth in profitability over the next 1-2 years. So that I think is kind of instilling confidence back in the small cap space, and which is where in terms of flows you've seen it to be as the second best category in terms of flows that they've got. And from an average 3,000 odd crores that we were seeing entering, this time it's jumped to around 4,000 crores of net flows in small cap.
Exactly. Shweta, now talking about continuing your SIP, although the numbers really are very interesting, retail investor numbers, especially after we look at the outflows coming from FIIs. In the month of April so far, we've seen almost 32,000 crores, they've been net sellers with this kind of a number. Vis-a-vis the DIIs and retail investors are really holding on to it very strongly. But then now, what is the reason for one to increase their SIP? What is the rationale that you might want to give? Because obviously, if you've started investing 2 to 3 years by SIP, you must have invested at market high. Now it's really crucial for you to, accumulate those units, and this entire year can actually be called as an accumulation year. How do you look at why is it important not to stop your SIP right now? You might just want to shuffle up or revamp your portfolio in terms of market caps, move more heavy towards large cap to get more stability. But you always come up with great data, Shweta, which is why I'm asking you if you could just give us some background data-wise.
Perfect. So, going back to basics, the concept of SIP is that it gives you the rupee cost averaging, which means in periods like this, you get that averaging benefit and the number of units you could accumulate would be far more. Second, I have two important, I think, very interesting data points that I can share here. And this is one study that I've done from 2001 onwards. If you see, if someone had invested in SIP, let's say in large caps, Nifty 50, if I take as an example, the first year, there is a possibility that, if I take 5-year blocks of SIP, and the first year when you started, you've made negative returns, right? So 12 installments gone in, you're sitting at negative returns. The negative returns would be an average 20%. If you continue to stay invested and do your SIPs for the next 4 years, the 5-year cumulative, the compounded average return of these SIP would be around 12.5 to 13%, which means what you've lost in the first year, more than that has been covered up in the following years. And this has happened in all instances where the first year would have been a negative return. Moving down to mid and small, let me talk about small cap. There's a high chance that there are those 18-19% instances where the first year of your SIP delivered negative returns for you. The average negative return turns out to be a minus 25-27%. The next 4 years, small cap index also rebounded, and there your 5 year CAGR comes up at around 17-17.5%. So, this is one telling you that you need to be patient and don't get swayed away by the first year of negative returns in an SIP. As you stay invested for a longer time period, markets rebound. One other interesting data point, if you just see the average rolling returns of Nifty, as long as you are a 7 year plus investor in equities, equities have given positive return. And if I just break it up into different ranges of more than 6%, more than 10%, then there's a 90% plus probability of getting more than what ideally debt would give you over the same time period. So it tells you that you really need to be patient. Don't get fearsome with interim volatility. Continue with your SIPs. In fact, these are the times when you should look at stepping up your SIPs, I would say.
All right. We'll be talking more on this as to why you should not be stopping your SIP. But then we also have a viewer queries on the show today, and I think we should totally go ahead with those queries now because we'll be running on short of time. Shweta, Anil Avinash Singhal's question we'll take first. Okay, he's got a couple of mutual funds: SBI Contra, Access Small Cap, Kotak Emerging Equity, Parag Parikh Flexi Cap. Currently, he's doing an SIP of 1 lakh. He's an aggressive investor and want to invest for 10 years and would like to step it up also by 10% every year. I do not have him on the phone line, so I don't know what's the corpus he's looking at and the kind of recommendations he's taken from someone or whether it is his own research. We won't be having any idea. But then, as he rightly said or called himself as an aggressive investor, we can see that in his portfolio as well. But then, okay, he definitely needs some more stability. So, would you want to add a large cap to his portfolio?
Yes. So Avinash, I was, actually seeing your portfolio. Now you're doing an SIP of 1 lakh, but your mid and small cap fund put together 60% is getting invested in these two schemes, which means roughly the exposure that you have to the space is around 60%. I would say that is really aggressive. And it not necessarily means that high risk would yield you high returns, right? You need to maintain a balance between risk and return. So look at reducing your exposure to mid small. I think around a 40% odd exposure is good enough. And given the situation also right now, that's what I would suggest. What you can exit, I would say Access Small Cap and Parag Parikh Flexi Cap. These are two schemes you should exit from. Instead, what you can add for an Invesco India Small Cap Fund, a Canada Robeco Multi Cap Fund, and I'm suggesting you one more scheme to add, which is the HDFC Flexi Cap Fund. So if you split it this way, you'll go a little heavy towards large cap, which is what you need. Plus your scheme level exposure could come down a little. So that's my recommendation to you.
Ah. All right. I think we have a caller on the phone line also. Hi, good evening.
Yeah, hi.
Hi, Kumar. You're calling from?
Yeah, I'm calling from Ranchi, Jharkhand.
All right. Okay, so you want to ask about NPS or tax benefit on NPS?
Yeah, so initially I was in old regime, right? So I was taking both corporate NPS plus personal NPS as well, 50,000 one, right? Now I'm
Right.
trying to opt out of tax regime, right? That old one and trying to go to a new tax regime, right? So will
Sure.
it be beneficial for me to still invest in NPS or should I opt for personal stock investment?
Okay. I just want to understand NPS as an investment option is actually, I mean, tax saving is a definitely hooked, a very nice hook to it, but it is also a retirement investment option. Do you have your portfolio aligned in that way, which is going to provide you for your retirement corpus?
I've not considered anything as of now in the NPS portal for
Okay.
retirement.
So that is the whole purpose behind having an investment strategy, Kumar. And a lot of time we also advise our investors. Uh, do you have tax saving options as per the old tax regime? Try and align them with your financial goals. NPS is a wonderful product if you align it to your retirement goal for your retirement purpose. The way I think you have taken it up for tax saving purpose, which is of great advantage or great benefit on this investment option that you get. But now since you are in the new tax regime, you can still invest in NPS and get an employer contribution benefit. Shweta will be able to explain this to you better. But as far as the whole intent of investing in NPS goes, it is for your retirement purpose. And be it NPS or be it regular mutual fund, you get tax benefit on it or you do not get any tax benefit on it. Just have the intent right. Shweta.
Absolutely. So Kumar, one, I also would want to understand, how much time do you have for retirement? Like Kavita was explaining that with the NPS, two benefits that you would have is definitely it helps you plan for your retirement. Second is the tax advantage that you get. Now, that 50,000 additional that you were doing was giving you that extra tax advantage, which if you shift to the new tax regime, you don't really need it. But the collateral benefit that you were getting for your retirement planning is, you will need to plan for that if you're not doing an NPS. You can continue to do NPS from a retirement planning standpoint. Alternatively, I'm giving you an alternative now because, when you do an NPS till the age of 60, your money is blocked. Even after that, a portion of it is what you will get lump sum, a portion you will get it as, accrual that you would keep getting every year. If you want more flexibility in terms of how much outflows do you want, how much withdrawal you would want to do every year, the money that you were doing in NPS, instead you should follow an asset allocation for that. Uh, I'm not too sure of the kind of investment horizon you have. Do you have 5 years, 10 years, 15 years to your retirement? If you have a longer tenor, we've seen, 70 to 80% equity also works, and the balance in debt works for you. It'll help you compound and grow your money at rate of returns, which would be very similar to what NPS rate of returns could be for you, but with the flexibility of having withdrawals of your choice and at frequencies of your choice. So that's an alternative solution for you to plan your retirement. And you don't have to worry about the tax incentive any which ways because you're in the new regime.
All right, a lot of investors, Shweta, looking at the volatility in the market, are moving. They want to opt for maybe insurance and investment linked products. They want to opt for NPS. Direct equity plans are, they don't find it very attractive looking at the volatility. Do you think it's the right time to have these kind of products in the portfolio as well? Because they think that this might just give them insurance coverage of insurance, and also a part of investment can go into it. Although in a long term perspective, and looking at the kind of benefit over inflation that equity has given, one might not want to take this kind of a strategy, especially products where you get a mix of insurance and investment. But the fear component really plays on you, okay? And which is why someone who had just tried their hands in equity definitely are not aware of what the volatility of the market. They are they get very jittery looking at this particular movement, and which is why they again fall back on the traditional way of investments, which could also be an insurance come investment product in insurance, or something like an NPS where a longer lock-in troubles them, but at least they have that peace of mind. What will you say?
Kavita, you're right that what happens is most often than not, we look at our investments more from a product standpoint rather than a portfolio. What I'm trying to say here is that, see, you have this option of this 1 lakh, you either putting in an insurance plus investment kind of a product, or you may call it as a ULIP, or an NPS where the money was getting blocked for you, you don't have control over it, you cannot withdraw it, and it's a combination. So it's providing you some kind of better performance or lower volatility as compared to pure equity. But instead of doing that, that same 1 lakh, if let's say you're following an asset allocation for it, and this is the key. Let's say you're investing 70 in equity, 30 in, when the markets are correcting, don't only look at the performance of that 70%. See that entire 100, how has it performed? So if in this situation, let's say last year, or from the fall, the markets have fallen by 10% in the last 6 months, and your portfolio, because you had that equity debt combination, and within equity, you had some active management playing for you, is, still maybe just down by 9% or has barely met the market performance, then you have to have a holistic picture in your mind and look at it in its entirety. That will help you remain calm and continue with your strategy, which will benefit you in the long term. So I'm just repeating, don't go product specific, but look at your entire portfolio as a whole and see how it's performed. And if you keep doing this, if you keep reminding yourself, these, being 100% investments of equity plus debt, and this approach would work better than a lot of these traditional products of ULIPs, and sometimes which also come in at higher cost. They'll lock in your liquidity for an extended period. They'll work far better for you.
All right, very important point to note that you should not be having a product-based strategy, have a portfolio-based strategy. Let's move on to Sanjeet's question. And he wants to deploy some cash in mutual funds and would love your expert opinion on this. He is looking to invest 1.5 lakh initially and then start an SIP of 20,000 per month for 5 years. He's shortlisted few funds for himself: ICICI Blue Chip, Nippon Small Cap, Edelweiss Mid Cap, Parag Parikh Flexi Cap, Edelweiss Greater China. And he wants to understand if the purpose of diversification is really solved as per this selection. And yeah, for 5 years period, what will be your recommendation if not these funds?
Sure. Sanjeev, I would say you've tried to diversify it as much as you can from a market cap allocation standpoint, from an AMC exposure standpoint. Just a few suggestions from my end. I would say, looking at the current, global scenario and where the different economies could get impacted, I think India per se is far better placed compared to a lot of the global peers. So having your allocation 100% Indian equities may work the best for you at this point of time, even if I'm looking at it the next 3-5 years. So I wouldn't recommend an Edelweiss Greater China fund for you. The other fund where I would say you must, you should ideally reconsider your allocation would be an Edelweiss Mid Cap and a Nippon Small Cap fund. Instead, what you can add on to your portfolio, you can consider a Kotak Emerging, an HDFC Small Cap, as well as a DSP Equity Opportunities Fund. So you can start with these, 4-5 funds in your portfolio. Keep reviewing them once every year. So I'm shifting you to 100% Indian equity, but spreading out across a large mid small exposure for you.
And definitely, geographies like China might not be the right time to put your money in. In fact, diversifying internationally, if it's good if one can just hold on for a few more months. Let's take Anantha's question. And he says that he is 32 years old. SBI Focus Fund 20,000 SIP, Tata Small Cap 2000, Parag Parikh Flexi Cap 2000. 20 years time horizon. I don't know the corpus that he wants to accumulate.
You have a very long-term horizon, and if you just continue with 6,000 SIP, this will get you to somewhere around 60 lakhs. That's the rough math that I had done. I hope that will help you achieve your objective. If not, consider doing and step up to your SIP 5%, 10%, whatever you can. Now, since you're just starting off your portfolio, I would suggest another basket of funds altogether for you to invest in. Try and stagger it. Try and have 4 schemes at least in your portfolio. So 1.5 thousand in every scheme. Diversification schemes that I suggest is you go in for a Kotak multi cap, an ICICI dividend yield fund, one Invesco small cap, and an SBI large and mid cap fund. So I'm trying to get you a mid cap exposure through other categories and have a small cap fund because you have a 20-year horizon, plus reduce scheme level exposure. So this is what you can start with. As you go on increasing your SIP, you can go on adding one or two more schemes to the portfolio.
All right, with that, it will be a wrap on the show. Thank you so much, Shweta, for taking time out and answering our viewers' portfolio queries today. Thank you so much. And for our viewers, I'm going to leave you with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.